You could literally score a perfect 100 on a financial literacy test, completely understand the math of compound interest, and you'd still probably underperform the very mutual funds you hold by like more than 1% every single year.
Yeah, and I mean, a single percent doesn't sound like a total catastrophe at first, but, when you stretch that tiny gap over a 30-year investing horizon,
It's huge.
exactly, it literally becomes the difference between a completely secure retirement and, well, spending your later years just constantly stressing about money.
Right, and the real kicker here, based on the research we're diving into today, is that this underperformance has absolutely nothing to do with, like, picking bad stocks or paying high fees.
No, not at all.
It happens because of a biological glitch in the human brain, like a glitch that makes us move our money at the exact worst possible moments. So for this deep dive, our mission is to figure out why incredibly smart people make just terrible money decisions under stress, and more importantly, how you can actually protect your portfolio from your own biology.
The data on this is wild. It completely shatters all our traditional assumptions about, who makes financial mistakes. The research actually shows that people who score incredibly high on those financial literacy tests, they panic sell during crashes at almost the exact same rate as people who know nothing about finance.
Wait, really? The exact same rate?
Pretty much, yeah. During the sharpest single-day crashes in history, individual trading volume spikes by over 300%. And almost all of that is selling.
Which brings us to this massive contradiction, right?
Yeah.
Because we all know the golden rules, you hear them everywhere, like buy low, sell high,
Mhm.
or time in the market beats timing the market. Everyone listening to this knows the historical averages. We all know markets eventually recover, so why the absolute second our account balance turns red do we feel this overwhelming, almost physical urge to hit the sell button?
Well, the broader picture tells us that just having the information is not a shield. Knowing about diversification barely changes what you actually do when you're staring at steep, immediate losses. To understand why we panic sell, we kind of have to put away the spreadsheets for a minute and look inside the human brain.
Okay, let's talk about the amygdala hijack then. Because reading through these sources, I realized this whole phenomenon is essentially um, human evolution fighting your wallet.
That's a perfect way to put it.
Hmm.
So deep inside the brain, we have this small, almond-shaped structure called the amygdala. Its primary job is just to process threats. And it does this incredibly fast.
Like faster than we can even think.
Way faster. It operates much faster than your conscious, rational brain can even boot up.
But the amygdala isn't exactly nuanced, though. It's basically just a loud alarm bell, right?
Yeah, it's a very primitive alarm bell. It genuinely cannot tell the difference between a physical predator in the wild and, say, a sudden 20% drop in your retirement account.
Oh.
Yeah, when you see that plunging red number on your screen, your amygdala perceives a direct threat to your actual survival. It triggers the exact same stress response as if your life were in physical danger. Within milliseconds, you get this massive flood of cortisol and adrenaline in your bloodstream.
So your heart rate goes up, your pupils dilate.
Exactly. Your focus narrows entirely onto the perceived threat. Your body is instantly preparing you to fight or flee.
So checking a plunging stock portfolio is basically the biological equivalent of suddenly running into a bear in the woods.
Yep.
Your body just starts screaming, run! And in the modern financial world, fleeing translates directly to, well, liquidating your assets.
Precisely. This biological fight-or-flight response evolved over hundreds of thousands of years to keep us alive. It's highly effective for dodging physical danger. But it was never designed to evaluate a globally diversified retirement account.
Let me push back on this a bit, though, because it feels like there should be an intellectual override, right? Like, if I deeply study market history, if I read the daily financial news, if I just build a stronger mental model, won't that logic eventually train the amygdala to stay calm? Can't I just outthink the bear?
Because of the way our neural pathways are structured,
Yeah.
the answer is sadly no.
Really?
Yeah, logic lives in a slower, newer part of the brain called the prefrontal cortex. When you're under acute, sudden stress, the emotional brain simply travels on a faster neural highway. It wins the foot race every single time.
Wow.
By the time your rational brain even starts trying to recall market history, your emotional brain has effectively sold your stocks like 3 seconds before your hand ever touches the mouse.
Your feelings move faster than your facts. That phrase from the research really stuck with me, and since biology overrides logic in the heat of the moment, we can actually see the financial damage play out in the data, right? Oh, we can trace it perfectly. Just look at the well-known study from the University of California. They analyzed actual brokerage account behavior and documented the real-world effects of what they call myopic loss aversion.
Right. The UC researchers found that investors who check their portfolios the most frequently actually earn significantly lower returns than people who check rarely, which is wild. But to understand why, we really need to break down the mechanics of loss aversion because it explains so much of our daily money anxiety.
Definitely. So loss aversion is the psychological principle that the pain of losing something feels roughly twice as intense as the joy of gaining that exact same thing.
So if I find $100 on the street, I feel a quick hit of joy.
Right. A brief hit of dopamine. But if you lose $100 from your wallet, it ruins your entire day.
It totally does. So apply that to an investing app. Let's say the market goes up slightly more often than it goes down over a given year. If you check your app every single day, you're going to see a lot of green days, but you're also going to see a lot of red days. And because of loss aversion, every one of those red days registers as a severe psychological blow, while the green days barely register as a win.
That sounds exhausting.
It is. By constantly exposing yourself to the daily noise of the market, you are essentially grinding down your own emotional risk tolerance. You feel like you're losing constantly, even if your portfolio is actually flat or even slightly up for the year.
And that chronic emotional fatigue is what eventually pushes those frequent checkers to move to lower yielding, quote unquote, safer investments, right?
Yeah.
Just completely destroying their long-term growth.
Exactly. Which leads us perfectly into the research from Yale University. They documented a related phenomenon called the disposition effect. It basically shows the sheer emotional gymnastics we perform just to protect our egos.
Yeah, the Yale study demonstrates that investors are far more willing to sell their winning investments entirely too early, but they will hold on to losing investments way, way too long.
And when you break down the mechanics of why we do that, it makes complete psychological sense. Selling a winning stock locks in a victory. It validates your intelligence.
You get to feel like a financial genius who outsmarted the market.
Right. But selling a loser, that forces you to confront the psychological pain of a realized loss. It forces you to update your self-image from savvy investor to person who made a mistake.
The spreadsheet screams at you to cut your losses and reallocate. But the human ego whispers, like, just hold on until it gets back to the price we bought it at so we don't have to admit defeat.
Exactly. We prioritize our immediate emotional comfort over a long-term financial reality.
This is why Delbar, that firm that tracks investor behavior, consistently finds that average investors trail the market indices. We buy high because the herd mentality makes us feel safe, and we sell low because the fear of further pain just becomes unbearable.
The National Bureau of Economic Research published multiple papers reinforcing this too. A person's immediate emotional state is the single strongest predictor of whether they'll make a panic-driven financial decision.
Not their education.
Nope. It completely overrides their education level, their income, and their financial literacy score.
Okay, but this raises a serious conflict for anyone trying to be, a responsible adult. Because checking an app and reading the financial news feels like the responsible thing to do. If the market is plunging, my instinct is to turn on the news, read the analysts, and stay highly informed. Isn't staying on top of the news cycle critical during a crisis?
The research vehemently disagrees with that instinct. Heavy financial news consumption during periods of market volatility actually spikes your anxiety and leads to worse decision-making.
It doesn't give you control.
Not at all. Financial media is designed to capture attention, and nothing captures the amygdala's attention quite like threat and panic. Watching the news during a crash just provides a steady, paralyzing drip of adrenaline.
So if checking constantly and obsessing over the news is dangerous, what actually happens when the pain gets too high and we finally cave and hit sell? Because the assumption is that the market crash itself is what ruins a portfolio.
The crash lowers the portfolio's value temporarily, sure. But the permanent financial damage happens in the weeks and months after the crash, when fear convinces people to stay out of the market entirely.
Right. People move to cash and they tell themselves they're just waiting for things to feel safe again before they reinvest.
And the tragedy of that strategy lies in how market recoveries actually function. A massive portion of a market's long-term gains happens in just a very small handful of trading days.
And statistically, those absolute best, highest gaining days almost always cluster right next to the most frightening, volatile days of a downturn.
They do.
We really need to explain why that clustering happens because it kind of defies common sense. Intuitively, it feels like a recovery from a major crash should take months of slow, steady optimism. Why do the biggest upswings happen while the news is still terrifying?
It comes down to market mechanics. During a heavy sell-off, prices drop so far that they trigger automated institutional buying thresholds.
Like the big funds stepping in.
Exactly. Large funds step in to buy massive blocks of undervalued assets.
Yep.
Simultaneously, short sellers, people who bet against the market, have to suddenly buy back stocks to cover their positions and take their profits.
Oh, that creates a short squeeze.
Yes, exactly. This combination of algorithmic buying and short covering creates sudden, violent upward spikes in the market, often right in the middle of the darkest headlines.
So if you're sitting in cash just waiting for the news anchors to sound optimistic and for the economy to feel safe again, you completely miss the math taking over.
By the time the news actually feels positive, the biggest percentage gains have already occurred. You miss the explosive rebound that makes long-term investing actually work in the first place.
The case study of Michael from our sources is just the perfect, tragic illustration of this waiting for safety trap. So Michael is 38. He's been contributing to his retirement accounts for over a decade. He knows the historical data. He knows markets eventually recover.
But knowing the data intellectually doesn't turn off the amygdala.
Exactly. So over a few weeks, the market drops sharply. Michael starts checking his account multiple times a day. He's reading all the doom and gloom headlines. He's feeling that slow buildup of physical dread.
That chronic fatigue we talked about.
Right. And finally, after a particularly brutal trading day, the pain of loss aversion just becomes too much. He logs in and moves his entire equity portfolio into cash.
He was just trying to stop the psychological bleeding. And what was his internal justification again?
Well, he told himself he wasn't quitting the market. He was just stepping back until, quote, things calmed down. But by the time the economic data looked positive again and he actually felt safe enough to reinvest, 8 months had passed.
Oh, man.
Yeah. The market had experienced a massive, rapid recovery while he was just sitting in cash. He missed the entire rebound, permanently locking in his losses, all because he was waiting for a feeling of safety that only arrives after the gains are gone.
Emotional timing works against investors almost every single time.
It's like pulling your car over to the side of the highway during a really heavy rainstorm. You tell yourself, I'm just going to wait here until the roads are completely dry. But by the time the roads are totally dry, the storm actually passed hours ago. Everyone else has driven hundreds of miles and you've missed the entire road trip.
That is a brilliant way to conceptualize it.
Mhm.
You are trading your long-term financial progress for, like, a few hours of short-term emotional comfort.
So we know that giving in to this physical panic ruins our long-term growth. The real question is, how do we stop the physical panic response in the first place? And this was honestly the most surprising revelation in the deep dive for me. The defense doesn't start in your portfolio. It starts in your physical body.
Yeah, your nervous system doesn't compartmentalize stress. We have to look at the direct, measurable connection between our physical state and our financial choices.
The sources highlight sleep, caffeine, and checking behaviors. They show a direct link between poor sleep and a severe drop in self-control and impulse management.
Right. If you're lying awake at 2 in the morning stressing over a market correction, you are in the worst possible biological state to be making a financial decision.
The logic center is offline.
Completely. The prefrontal cortex is exhausted. You're highly likely to make a rushed, reactive trade in the dark that you would never execute with a clear head after 8 hours of sleep.
And then there's the caffeine factor. Like, high caffeine intake during an already stressful economic period amplifies the physical symptoms of anxiety. Your mind might logically know it's just a routine market correction, but your body is treating it like a 5-alarm fire because you're running on 3 espressos and a massive cortisol spike.
The behavioral research actually advocates for physical interventions here.
Hmm.
Regular movement, consistent sleep schedules, and even short breathing exercises actively lower your baseline cortisol levels.
Just general health stuff.
Yeah, but a lower physical stress response translates directly into calmer, more rational financial decision-making.
Okay, wait, I have to challenge this a bit. If my portfolio is bleeding 5% in a single morning, the idea of stepping away from my desk to, like, take a walk feels completely irresponsible.
I know, it feels counterintuitive.
My brain is screaming that I need to stay at the computer and manage the crisis. How does taking a walk actually stop the financial bleeding?
Because in that moment, you aren't actually managing a financial crisis. You are managing a biological crisis. When the amygdala fires, that flood of adrenaline and cortisol takes roughly 10 to 20 minutes to actually metabolize in your bloodstream.
So for 20 minutes, you're just pure emotion.
Yes. During that window, your prefrontal cortex is essentially offline. You are physically incapable of making a rational, math-based decision. Taking a walk isn't about ignoring the market. It's about actively resetting your hardware so your software can boot up properly. You're basically buying time for your logic to come back online.
Oh, I see. You have to metabolize the panic before you can analyze the portfolio.
Precisely. Even maintaining small daily routines, like a fixed morning schedule or a regular workout, helps anchor you. It makes the physical environment around you feel controllable, which psychologically makes unpredictable financial news feel far less threatening.
So we calm the body down, we take our walk, we regulate our sleep. But as the research points out, self-awareness is not a permanent shield. Just knowing why your brain panics doesn't automatically prevent the panic next time. Willpower is a depleting
Oh,
resource.
absolutely. Willpower will eventually fail under enough pressure. We cannot rely on it. We have to build structural defenses. We need to build an automated system where the right decision is just the easiest decision to make.
The sources laid out several incredibly practical steps for building this structure. The first, and maybe the most crucial, is writing down an investment plan long before a crisis ever happens.
Yes, a physical document that clearly outlines your specific goals, your time horizon, and the highly specific rare conditions under which you would actually sell an asset.
So when the market drops and the stress hits, you aren't consulting your panicked, cortisol-soaked mind. You're consulting a calm, rational document you wrote when you were thinking clearly.
Exactly. It acts as an anchor to your past rational self.
The second structural defense is setting a rigid schedule for checking your accounts. Perhaps it's once a week or even once a month.
And as we saw with the myopic loss aversion data, simply reducing your checking frequency dramatically reduces your emotional volatility. The market hasn't changed at all, but your psychological experience of it becomes so much smoother.
Another defense the sources heavily emphasized is maintaining a highly visible emergency fund. Cash sitting in a standard bank account, explicitly labeled for life emergencies, completely separate from your investment portfolio.
This directly addresses the underlying psychological terror of a crash, because a lot of the panic around a market drop isn't actually about the stock market itself.
It's not.
No, it's the unconscious fear of what if I lose my job tomorrow or my roof caves in and I need cash right now, but my portfolio is down 20%.
Ah, right. So having that separate cash cushion severs the link between market performance and daily survival. It quiets the fear before it even has a chance to start.
Exactly. And that cash cushion sets up the next crucial structural defense,
Yeah.
automating your contributions.
Taking the choice out of your hands entirely. If your investing is automated, transferring a set amount every single month regardless of the news, it just happens without requiring a fresh emotional decision.
You remove the very moment of choice where fear and hesitation usually strike.
And if a major crash happens and you do feel that overwhelming urge to log in and make a drastic move, there's one final circuit breaker, the 24-hour rule.
Yes, this is so powerful.
The case study of Jennifer illustrates this perfectly. Jennifer is 46. She's juggling a mortgage, her kids' education funds, and her own retirement. The market takes a sudden, sharp downturn, and she fully panics.
Which is a totally normal biological response.
Right, so she opens her brokerage app, intending to sell a massive equity position. Her cursor is hovering directly over the confirm button.
Her amygdala is entirely in the driver's seat.
Fully hijacked. But then she remembers the 24-hour rule she set for herself. She forces herself to write down the exact trade she wants to make and the reasons why, but she refuses to execute it for one full day. She just closes the app.
The crucial part is what happens during those 24 hours.
Exactly. The next morning, the adrenaline is gone, the cortisol has metabolized. She's still uneasy about the headlines, sure, but she's no longer in a physiological state of panic.
Her prefrontal cortex is back online.
Yep. She reviews her written long-term plan, reminds herself that she doesn't actually need to access this money for another 15 years, and she decides to do nothing. Months later, her account recovers and reaches new highs. She realizes that forcing herself to do nothing was the most profitable financial decision of her life.
She didn't try to outsmart her panic in the moment. She just built a structural delay that gave her rational brain the time it needed to win the race.
It's the exact same logic as leaving items in an online shopping cart overnight to see if you really still want them the next morning.
Oh.
Except this time, instead of saving you from buying, like, an impulse gadget, the pause is saving your entire retirement trajectory.
It's a brilliant structural circuit breaker. The research also suggests taking that written note and keeping a simple decision journal, like documenting the fear that drove you to almost sell and reviewing it a year later.
Oh, that's smart.
Yeah, you quickly realize just how many of your absolute worst-case financial fears never actually materialized.
Bringing this all together, the core mindset shift required here is really profound. We have to stop viewing market drops as a personal failure or a five-alarm emergency. We need to start viewing them as a totally normal, mathematically expected part of long-term investing.
And we must shift our measurement of success. We cannot measure financial health day to day or headline to headline. We have to measure it across decades.
Your actual financial timeline is almost certainly longer than whatever news cycle is currently spiking your cortisol.
Exactly.
Whether you are in your 20s, just setting up your first automated index funds, or you're in your 50s, trying to protect your peak earnings as you approach retirement, these psychological defenses are critical at every single stage. Because as the data makes crystal clear, willpower will fail you. Structure always beats awareness.
Having a system that makes the right decision the easy decision is far more powerful than simply knowing what the right decision is.
As we wrap up this deep dive, I want to leave you with a final thought to chew on. We've spent this entire time exploring how our brains are biologically hardwired to be absolutely terrible at managing long-term financial investments.
Which is completely natural, by the way.
Right. Our core instincts are exquisitely designed for escaping predators on the savannah, not for managing compound interest and market volatility. So it really makes you wonder, what other modern high-stakes life decisions are you currently making using those exact same prehistoric emotional instincts?
If a biological stress response can so easily knock down the mathematical blueprint of our finances, where else in our lives is the foundation cracking simply because we felt a sudden spike of adrenaline?
Something to mull over next time you feel the overwhelming urge to hit the panic button, wherever that button might be in your life. Thanks for taking this deep dive with us.